Welcome to the Deep Dive. Today, we are taking a massive swing at one of the foundational giants in global healthcare, Fresenius Medical Care, or FMS.
Yeah.
They are essentially the global infrastructure provider for kidney and dialysis patients. And what's so fascinating right now is that this enormous, entrenched company is attempting a radical internal transformation.
Yeah, it's absolutely right. Our mission in this deep dive is to synthesize a stack of sources, primarily a really comprehensive research report from Compasscope, and we're combining that with FMS's latest, very detailed Q3 2025 earnings update.
And the goal here is to cut through the complexity, right?
Exactly. We need to understand how this highly vertically integrated model is trying to turn around its margins and navigate these massive regulatory and technological shifts. It's a very complex, very regulated market.
Okay, so we'll guide you through their business model, the intense competitive landscape they're in, their aggressive roadmap for margin expansion, and crucially, all the execution risks involved.
And then we'll look at that recent Q3 scorecard to see if the plan is actually, hitting its targets.
All right, let's unpack the business blueprint first.
Let's do it.
So at its core, FMS provides life-sustaining care for millions of patients suffering from end-stage renal disease, ESRD, and, related chronic kidney conditions.
And when you say massive scale, you really mean it.
I do. They operate a global network. They're in developed markets like the U.S., and they're actively expanding into these higher growth emerging markets. But the fundamental strength here, the thing that makes them unique, is that vertical integration.
Think of them as controlling the entire supply chain. I mean, from manufacturing the medical equipment all the way to delivering the actual treatment. They break down into two core interlocking segments.
Okay.
So first you have dialysis services. That's the care delivery component.
That's the part the patient actually sees.
Exactly. It's the, approximately 3,700 clinics they have globally offering in-clinic hemodialysis.
And crucially, that whole segment is changing really fast, isn't it?
It is. Within that care delivery bucket, two critical areas are really accelerating. One is value-based care services, which is largely driven through their platform, Interwell Health.
Right, so that's shifting away from fee-for-service.
Yes. It shifts the focus to managing patient populations, aiming to reduce costly hospitalizations while improving outcomes. And then the second big push is into home dialysis services, which was massively accelerated by their earlier acquisition of NxStage Medical.
So the future of care is moving out of the clinic and into the home.
And FMS is racing to catch up there.
And the reason that integration is so powerful is the flip side, the fact that they're also the supplier.
Precisely. That's the medical technology and products segment, or what they call care enablement. They manufacture the machines, like their high-volume 5008 series platform, and all the consumables, dialyzers, the bloodlines, the fluids, everything.
They even have ancillary businesses, right? Like pharma manufacturing.
Yep. They make specific dialysis-related drugs, like phosphate binders, and they're investing in R&D for transformative emerging therapies, things like, artificial kidneys.
So if they control the product manufacturing and the service delivery, that's a major advantage. The key takeaway for you, the listener, is that FMS's core strength is its ability to optimize that entire process controlling quality, cost, and logistics from start to finish.
Well, that's the theory. But if we shift to the competitive battlefield, FMS's advantages, that global scale, the 35% market share in products, differentiated tech like NxStage, they're all being undermined by a massive internal conflict.
Okay, here's where it gets really interesting, because the source material flags a serious structural issue, the medtech margin weakness.
Yeah.
This means that the care enablement segment, the part that actually makes the physical products, is acting as a financial drag on the whole company.
It's the paradox of their integration. While they gain these logistical advantages, that medtech segment has been underperforming for a while.
Why is that?
Well, they're stuck with legacy, long-term pricing contracts that are just unfavorable. And they've been hammered by global cost inflation, materials, labor, logistics, you name it.
So the manufacturing arm is basically subsidizing the services arm.
Essentially, yes. It's preventing the whole group from achieving better profitability. The report calls it a value drain.
But if they have this global scale and they control the manufacturing, why can't they just fix those contracts? What makes it so difficult to turn around?
It's time and regulation. I mean, these are multi-year contracts, often covering thousands of clinics or hospital systems globally. Renegotiating involves complex regulatory hurdles in different countries. It's not just a simple supply chain negotiation.
I can't just flip a switch and raise prices.
Not at all, especially when a lot of the final payment comes from tightly controlled government payers like Medicare in the US.
And let's not forget the external threats. I mean, beyond that regulatory pricing pressure, the long-term threat of emerging technologies is always looming.
Right. We're talking about advancements like miniaturized artificial kidneys, which could eventually reduce the need for clinic-based care.
And even more immediate, the huge societal shift caused by the GLP-1 weight loss drugs.
That's the long-term cloud for sure. Since diabetes and obesity are the primary drivers of ESRD, successful weight loss drugs could, over decades actually reduce the pool of new kidney failure patients.
Which is great for society, but a headwind for their business model.
A major headwind. And FMS has to plan for a scenario where its primary intake stream slows down.
If you compare FMS to its key peers, it really clarifies their unique spot. You have DaVita Inc., which is U.S.-focused and great at services, but lacks the product side.
Right. And then there's Baxter International, a product leader, especially in peritoneal dialysis, but they don't have that massive service clinic network.
So FMS is the most complex of the three.
By far. But it's also arguably the most defensible if they can fix that margin drain. DaVita is exposed to U.S. pricing risk, Baxter to global medtech competition. But FMS has to manage both sectors and all their risks at the same time.
Which brings us directly to their roadmap. So given all this complexity and that nagging medtech margin weakness, they've laid out a really ambitious plan.
Their goals are not small. They are targeting mid-teens operating margins by 2030. That is a massive jump from where they've been operating.
Mid-teens, why?
And they have an interim goal of hitting 11 to 12% margin by the end of 2025.
So how do they get there?
Yeah.
They call the vehicle for this transformation FME 25 plus MOM. It sounds a bit like a generic corporate slogan, but it seems to be the key tool.
It is. It's basically the internal bloodletting program. FME 25 Plus is a global cost optimization and restructuring initiative. This means simplifying their administrative layers, optimizing their manufacturing footprint, maybe closing less efficient plants, and getting really aggressive on centralizing procurement to cut waste.
It's about moving from a siloed, complex, global company to a streamlined one.
Exactly. And this cost-cutting is happening alongside a massive shift in capital investment toward new technology.
Right.
Yes. They are betting heavily on the future of care delivery. That means significant investment in the NxStage home hemodialysis platform and rapidly rolling out their high-volume 5008 platform.
That's strategic. Value-based care and home care. They often carry better long-term profitability than traditional in-clinic care.
Assuming patient adoption scales up, yes. And they're also prioritizing expansion in high-growth emerging markets, places like Brazil, the Asia-Pacific region, to make sure that top-line revenue growth continues even if developed markets start to slow down.
Okay, but mid-teens margins by 2030. That sounds fantastic. But given the scale of this restructuring in the regulatory environment, how credible is that target? It feels like it requires hitting multiple levers perfectly.
It requires near-perfect execution. I mean, DaVita's growth relies on signing more value-based contracts in the U.S. Baxter relies on product innovation. But FMS's strategy is broader. It's cost cuts, plus tech adoption, plus margin recovery.
And that breadth inherently increases the risk.
Absolutely. They have to successfully turn around those medtech margins. If that fails, the whole 2030 target becomes, well, pretty questionable.
So let's dig into that execution risk. The global integrated structure we identified as their core strength also makes them inherently more complex to steer and transform. What are the specific speed bumps?
The first, and I think the most critical, is the medtech recovery risk. Can they successfully renegotiate enough of those unfavorable pricing contracts to stop it being a drain? If they fail there, they just won't hit that 2030 goal.
Okay. Second has to be the FME 25 plus risk itself.
For sure. This is an immense global restructuring, and history is full of companies that announce these massive cost-saving programs only to get derailed by operational delays, unexpected costs, internal friction.
The savings they're forecasting are crucial. Any delay is immediately going to hurt margins.
Then there's the adoption risk, especially for home technologies like NxStage and that advanced 5008 HDF platform. They're clinically superior, but they require more patient training, more physician buy-in, and big changes to clinical workflow.
So if patients or physicians hesitate to adopt it, the whole thing slows down.
Right. FMS risks sinking all this capital into technology that doesn't deliver the promised return quickly enough.
And because they're so huge, they can't avoid the external risks. They have high exposure to foreign exchange volatility.
Huge exposure. Global operations mean currencies can eat into your profit margins instantly, and they remain completely dependent on decisions made in Washington, D.C., particularly Medicare reimbursement rules.
It's a real tightrope walk.
It is. DaVita might only worry about the U.S. regulatory climate, but FMS has to balance global equipment pricing, currency fluctuations, and restructuring thousands of sites all at once.
All right, let's shift gears and look at the latest scorecard. The Q3 2025 performance. This is the proof of concept, right? Is the strategy actually working?
It is. And despite a tough external environment management, even noted complications from the ongoing U.S. government shutdown affecting policy, FMS delivered some pretty impressive metrics.
They're really good.
They showed accelerated momentum. Q3 delivered strong 10% organic revenue growth. But the more crucial metric was the bottom line. Operating income growth accelerated to 28%.
28%.
Yeah, pushing the group margin up to 11.7%. That jump is huge. It immediately places them right in their implied target range for the entire 2025 year, well ahead of schedule.
So that FME 25 Plus program is delivering. It generated, what, 47 million euros in sustainable savings in Q3 alone.
And management's confidence is up. They upgraded the full-year savings forecast for the program to a significant 220 million euros. That's tangible progress.
And a big part of that margin acceleration came from a powerful tailwind from the pharma business.
That's right. The anticipated benefit from their phosphate binders for the full year 2025 was raised substantially, from 100 million euros to an estimated 180 million. This outperformance in their drug manufacturing arm is acting as a crucial buffer.
A buffer against what?
Against headwinds like the lower U.S. volumes and those foreign exchange losses we talked about.
Speaking of U.S. volumes, they're still the underlying challenge here. U.S. same-market treatment growth was only just barely positive at 0.1% in Q3.
And this confirms what the sources call the carryover effect from elevated mortality, which was particularly high after that severe flu season earlier in the year.
It's a sensitive topic, but a vital one for the business. Lower treatment growth means less revenue per clinic.
It does. But management is emphasizing some encouraging operational improvements in quality metrics, things designed to improve outcomes and reduce mortality over time. They noted an 84% adoption rate of antimicrobial interventions for catheter patients,
Which is a key step in reducing infection risk.
a huge step. It reduces infection risk and subsequent hospitalizations.
And the investment in that high-volume HCF is starting to pay off clinically. The rollout in select U.S. clinics is underway, and management is highlighting some really encouraging patient feedback.
Yeah, things like increased energy, improved sleep quality, and significantly reduced recovery time post-treatment. The full launch is still set for 2026, but the early data definitely justifies the capital they've spent.
That's compelling.
It is. And finally, reflecting this improved performance, management started their share buyback program in Q3, beginning the first tranche of 600 million euros in August.
Using that increased profitability to reward shareholders while they continue the internal work.
That's the plan.
Okay, to wrap this all up, let's look at the critical factors you need to monitor. What should we be putting on the watch list for FMS?
I think number one, high importance, is regulatory certainty. You have to watch for the final publication of the 2026 ESRD PPS rule that locks in their reimbursement rates.
And in the nearer term?
In the nearer term, it's the potential expiration or renewal of the ACA-related tax subsidies. If those subsidies expire, it could drastically shift the payer mix for U.S. patients away from high-margin commercial insurance to lower-margin government payers.
That would be a major headwind.
A massive one.
We also have to keep tracking that dual trend of disease trajectories and global growth. The threat from the GLP-1 drugs curbing new ESRD incidents is a huge long-term structural concern.
And that needs to be constantly weighed against the relentless global growth in chronic diseases like diabetes and hypertension, which are fueling the patient base in emerging markets.
And of course, the internal levers, FME 25 plus execution.
It remains high importance. Achieving those cost savings targets really hinges on successfully completing the medtech business turnaround, improving that care enablement margin from a drain into a real contributor.
And we should also keep a, say, medium-high focus on getting those U.S. dialysis volume trends back on track, moving same-market growth back into the 2% plus range once mortality normalizes.
And seeing aggressive growth in home dialysis adoption, fueled by that NxStage technology.
So what does this all mean for you? FMS has a powerful integrated model, and is showing strong Q3 momentum. The transformation plan is actionable. It's successful in the short term, driven largely by cost discipline and that pharma benefit.
But its long-term success is a really complex balance between mastering execution risk and managing a volatile regulatory landscape.
So here's the final provocative thought for you to consider. FMS is investing heavily in patient outcomes, things like HDF, infection prevention, which inherently aims to reduce patient mortality and healthcare costs.
Right.
So if these quality improvement strategies, combined with the rise of preventative drugs like the GLP-1s, prove too successful at improving health and preventing kidney failure, does FMS, the world's largest dialysis provider, risk innovating away its own future patient base?
It creates a fascinating dilemma between fulfilling their clinical mission and preserving their core business volume. The ultimate test of this company may be how it monetizes health improvement, not just health maintenance.
That is a truly complex puzzle. Thanks for joining us for the deep dive.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.